And now I would like to introduce a great speaker, Bradley Leimer, who is coming from San Francisco to talk to you today and to give a keynote presentation on the profit conundrum and about what banks must learn from Silicon Valley and global platforms. So please join me in welcoming Bradley to the stage.
How's everybody doing? Check, check, mic check. All right. So why is profit a conundrum? Why is this an open question in banking? If you're in a bank, are you making enough money? Is a 20 to 30 to 40% profit margin enough? This is why my partner and I founded Unconventional Ventures. It's to question the profit and what we're doing with it inside the banking industry. It's to question the ability to serve everyone within this industry equal. So my question to you to start is not about profit. My lesson today is not about profit. It's really about what we're experiencing now within financial services. Is this an evolution of the model, or is this a revolution of the model? The way that I look at financial services is this. There's a certain poetry about financial services as it weaves a melody through all of our daily lives. Now, the way that we think about that melody and the way that we think in the prior panel about data and the way that we talk about monetization of these things, we should be really thinking about the impact that that experience of banking is in everything that we do. The more we have banking disappear, the more banking becomes valuable. So how you look at banking depends an awful lot about your background, where you were raised, where you live, where you travel. If you're here in Europe, you think about your better efficient payment systems than what the US has. We still write checks. You think about things in Asia, and you think about barcodes, and you think about massive volumes of payments. What is very, very clear is that what we're experiencing in banking today is something that in the future will be colliding. We experience a very different type of banking across the regions. But we are headed toward the same reality, where the experience of banking is going to be evolving into more and more platforms. What we see in China is going to evolve into other regions. What we see of the best cases of fintech is already spilling out to every single region. So again, where you live and what you experience is important to the way we think about profit. Now, I come from Silicon Valley, and if you've seen the television show, you will see that it's actually a pretty accurate description of what venture capital and startup culture is in the US and beyond. We like to think that we created the world in Silicon Valley, and in many cases, we just created the platforms that you all enjoy today. But it's great to say Silicon Valley has this great backstory of providing funding to startups that maybe change different markets. Those 4 garages that started out companies like Apple are now worth $2.9 trillion. So the lessons of Silicon Valley as they entered banking is this. Across the last 10 years, we put $155 billion into fintech. In the early days, 80 and 90% and beyond came from Silicon Valley. The Robin Hoods of the world and companies like that, regardless of where they were funded straight out of a single culture. Now, when you think about the lessons of that, and you think about $55 billion last year going into fintech, what has shifted is that the micro centers of both venture capital money and activity of startup creation has expanded to dozens and dozens of markets, where everybody is now Silicon Valley. The lesson that we have around funding is that anything is possible. That anything, when you're talking to a founder or a founding team, is possible. Serving the needs of everyone through technology is possible. Now, as we've evolved this business model, banking has been elemental to our daily lives. But banks are increasingly becoming less so. So while our tools may have evolved, our business models within banking itself have not necessarily kept up with that. Banks need to get back to the basics. Our business model used to be very simple. We took deposits in, we loaned money out, We established credit and other mechanisms for people to facilitate their daily lives. And we made fee income. We made other types of income on top of that. Now, where did it all go wrong? How in every single market did we go from hundreds and more banks, especially in the United States 30 years ago? We had 25,000 financial institutions. Now we have 9,000. Now in each one of your markets in Europe, you laugh and you say, well, we have 3 or 4. But when you have 3 or 4, what happens? You have a concentration of not just profit, but you have a monopolistic version of what value is to your customers. This again goes back to food, water, and shelter. How are we providing food, water, and shelter in forms of financial services to more and more people, and not just relying on what's called cross-subsidization, which is that 80-20 rule in banking, where 20% of people pay for the rest of the 80. We don't really care about the needs of those 80. We care about the 20 that are profitable. We care about the 1% when we build wealth management applications, because that's where all the money is. And we care about the 10% when we really build out the rest of the products. That's a broken model in today's environment. So technology itself has had an impact, of course, over the last 10, 15 years in financial services. It is everywhere when we talk about banking. You can't have a conference like this without having technology as the undercurrent of almost everything that we talk about. Technology, yes, is key, but leveraging technology in a different way to serve the needs of all is something that we're starting to see. Technology and the prevalence of a single model globally is what we are evolving to. Now, has that impacted banking's profit? No. The top 20 global banks made $468 billion in profit last year alone. They now control $46 trillion of assets. That's 20 banks. In the United States, there are 5,400 banks that made $236 billion in profit. And if you look at that long tail of banks, obviously the majority of that is in that top 15 that control over $14 trillion of assets in the US alone. Now, that's an awful lot of percentage of the 14 trillion going into a total market of 18 trillion in assets. Again, we'll see further consolidation, but banks are still making money. This is why large tech platforms in Silicon Valley and all of these funders are saying, look, if there's a good idea out there that could actually take just a sliver of that, we're going to go after that market. So if we think about why there's so much activity across the board in every single type of financial technology that affects every single thing that we do every day, it's because there's an awful lot of money to be made and there's an awful lot of fat inside that budget. So what are we talking about? Is this an evolution or a revolution in terms of the way customers see banking? In the United States, we like to talk about too big to fail. Well, what happened about too big to fail? Now we have more concentration in the top of banks. Chase is one of the largest banks in the world. All the banks in the US combined, again, are really rolled up into just a dozen or so. But customers are changing. In the next 5 years, you're going to see 85 million people in Europe alone using neobanks as their primary financial institution. That's 20% of the total population of Europe. You look at other markets and you look at Nubank, now 7 or 8 million customers in Brazil. You look at KakaoBank, they had a case study this morning. Tens of millions of people almost overnight, first year. And that was through a telco. So my current point of view is this. Obviously, we're seeing a shift toward open banking. A very transparent model, a low-cost delivery model is evolving into these large platforms. Customers are demanding more, and this is why you're seeing adoption by these fintechs. The global banking industry, especially in the US, is going to contract. You'll have much less competition up top and a ton of competition on the bottom, rising up toward meeting that. Big tech, big platforms are going to continue to unbundle and rebundle banking. And what we've seen so far in the last 12 years is nothing. I would still say that the most interesting global business models are in China. WeChat and Alipay, and you saw the numbers this morning. 1.3 billion people using the platform for WeChat alone. So why is that interesting? Well, because we have other large platforms in other markets that if they actually learned how to do payments, if Facebook one day decided to actually do something with their stablecoin idea and people actually trusted them enough to use it, then we'd see something very interesting. when WhatsApp became a counterfoil to Alipay and WeChat. How do we get here? There's a lot of things we could talk about, but in 2007, we had some really, really key things happen. In the early part of 2007, we had the launch of M-Pesa. M-Pesa, of course, came from Safaricom, but Safaricom watched what people were doing with phone credits in terms of transferring and using it as stored value. What was most interesting about that is back in 2007, there was nothing like it. In the middle of political strife, in the middle of a war, people were not able to move money. Having recently talked to somebody who was on the ground with their family, this changed lives. You had single-digit participation in banks, traditional banks in Kenya, before Safaricom launched M-Pesa. Now you have over 60% of the population using a bank. M-Pesa changed Eastern Africa and was the seed of the idea where WeChat and Alipay came to being. Payments as the center focus of a platform. Other things that happened in 2007, you saw the launch of the iPhone, which fundamentally changed the relationships that we have with our bank. It's fundamentally changed what you do about 2 or 3 hours a day, if you look at the stats. Other things that happened, there were the first conferences that were around financial technology, where you had 60 startups across 2 days show what they were doing. It's where companies like Mint launched. It's where companies like Simple launched and Movin launched. So we're talking about, yes, a lot of change in 1 year, but the 12 years subsequently, that's the beginning of when we started seeing funding in fintech startups. 2007 was also, of course, the Great Recession, which then led to a decade of low interest rate environments and an incubation period for fintech startups, which couldn't have been worse for banks. This is the rise of a technology and a force within financial technology that has given us competition that we didn't expect. The last thing that happened in 2007 was the Payment Services Directive, #1, launched at the very end of the year, 2 weeks after the Great Recession hit. Very good timing by EU. And when you think about what has happened in the 12 years since, it has opened up a Pandora's box. It has opened up this idea that regulation could actually open up innovation. And that's very, very interesting. So between tech platforms that we've seen grow, open banking now can be looked at as one thing and one thing only. It is this way that we are going to further open up, based on the regulators, a Trojan horse that is going to offer fintechs and large techs a way to get into your markets. Open banking isn't just about payments. It's not just about data. It's about opening up and building out a transformational business model. So what do we do with it? What do we do with open banking? When I talk about large tech platforms and I talk about a viewpoint from Silicon Valley, it's about opening up that long tail. It's about being able to serve more people profitably at scale that you were never able to take care of before. It's about niche conversations and applications. But some of these aren't niche. The fastest growing demographic, the most profitable demographic that banks are ignoring today are people over 50. People over 50 are not just a source of deposits. People over 50 are changing. Their needs are changing. We do things like drive down the cost of remittance begrudgingly because of TransferWise and other applications, and yet we don't go further. Why haven't banks squashed these other alternatives? Why haven't they actually done an undercut with the profit margins that they have? We look at other things like what foundations are doing. The Gates Foundation has launched a version of M-Pesa called Mojo Loop, which is open source and open and available to any fintech startup, any bank, any government, any entity to launch a similar platform. Let's see this happen. So it's about doing things like enabling other ways to build wealth on a daily basis. It's about looking at the balance sheet of our consumers and understanding that sometimes the bank's way of looking at a balance sheet from their perspective does not add value. This is why it's important that we look at alternatives. We look at alternatives to save people from starving themselves from debt, looking at ways for them to save and invest more, focusing on the income side and work opportunities. There are so many startups that are doing these things that as we look at open banking, we need to open up the value to our consumers. We don't do much for entrepreneurs. We don't do much for gig workers. We don't do anything to really provide inclusivity into our design. So if I'm going to preach from Silicon Valley, if I'm going to talk about large technology companies and what they've done to this business, they serve more people at lower cost and yet still be profitable. So Our opportunity is to serve truly everyone around us. People should be treated equally, and their financial needs should be treated equally as well, regardless of their background, where they've been, how much money they have, and absolutely how profitable they are. The revolution of financial services is to serve a diverse financial need for every single community that we are able to serve. We need to have a longer time horizon. We need to embrace the standards of open banking, which is transformation of business model. We need to broaden access to financial services to everyone. And this is the lesson of Silicon Valley. This is the lesson of WeChat and Alipay and other platforms like Bcash in Indonesia. You're changing societies, not just through payments, not just through the ability to save and move money, but the ability to, across generations, change people's lives. Inclusivity does not require creativity. We know what the problems of banking are. We know where the blind spots within banking services are. We absolutely understand that we could have impact together, working together. When you think about one thing, think about in the early 1970s, we had 60% of the world population living in extreme poverty. That's $2 a day. What's that number now? 10%. 10% of the world's population is living in extreme poverty. What can we do through open banking? What can we do through more inclusive business practices? We could not only take that number to zero, but we could take the 1.7 billion people that are unbanked to have opportunities to be banked. We've already seen a 600 million reduction in that number over the last 5 or 6 years because of payment platforms at scale. China significantly changing the way that people live. This is the lesson of Silicon Valley. Our greatest innovation is our empathy in changing our business model and the way that we view profits. So let's make banking better. Let's make banking open. Thank you.